So economic instability and growth, it's important for the economic environment and for global business growth. That's very important. So this is why inflation is best at 2% or at a low rate, because at a low and stable rate, because that allows for the economy to be stable and not constantly changing. So people prefer this for their economic growth. But that's very important for people in our economy and businesses. So government really focuses on keeping inflation there. And governments try to manage an economic balance. They implement policies that affect growth, employment, and price stability. So that's why government places a very high importance on inflation being 2%/3%. And they use monetary and fiscal policy to try and maintain economic balance. So they do that to keep inflation low and stable. So the government controls the level of money circulating in the economy through, they do this through changing the interest rate and changing money supply. So their main goals are usually economic growth, maximum employment, and price stability. So most all countries have a central bank. In Canada, the Bank of Canada is the central bank. And in the USA, the Federal Reserve is the central bank. And then the impact of monetary policy changes takes time. Forecasting is needed. And also current economic conditions as well as future predictions are considered. So the Federal Reserve Board manages and oversees monetary policy in the USA. Bank of Canada manages and oversees monetary policy in Canada. So they both set interest rates and control the money supply in those countries. They're the central banks. So other countries may work slightly differently. So you need to know each system when you're getting your company into that system. So these countries, so Canada and the US control their own monetary policy through changing their own money supply and interest rates. But European Union, they set their money supply and interest rates across the whole European Union instead of by each country. Yeah. So that's what they do there. That's very important. There's the European Union. They set the interest rate and money supply for all the countries in the European Union, while Canada and the US do it for each of their countries. So that's the big difference, and that can be a big issue in terms of the big issue about that is the big issue about this is like Italy, France, Spain, and other European Union countries use the same currency. Therefore, they cannot individually increase the money supply for their specific country to grow their economy. they have to get the European Central Bank to print more money to increase the money supply for all of the countries. So like France, for example, cannot just print money to get their government out of debt or finance government or finance spending on growing the economy through printing money. So they can't do this, which really makes options limited for these countries. They have very limited options in terms of what they can do, and that presents a problem for these countries. The European Union countries, like Eurozone countries, have fiscal policy as their main way to grow their economies and get out of recession, but they are limited in monetary policy because they need to get their central bank for all of the Eurozone to support all of them. So that makes it very limited, and yeah, it becomes a big issue. It makes it limited, and they can only use fiscal policy to get out of recessions, which is very limited for these countries. So I pasted that into the chat for everyone. Then the Federal Reserve, they can change interest rates. So the Fed is a central bank that loans money to other banks. They can raise or lower the rate they charge on their loans to other banks. Other banks then adjust their interest they charge on consumer and business loans accordingly. And they can also modify reserve requirements. So reserve requirements refers to the minimum amount that banks must hold in reserve against deposits and bank accounts to ensure it can meet any sudden withdrawals. So if the central bank increases reserve requirements, the money supply goes down. And then also, if the central bank reduces reserve requirements, the money supply goes up. So that's what happens here. And then buying and selling government securities increases or decreases the money circulating in the economy. So if the central bank buys government securities, the money supply increases and interest rates go down. And then if the central bank sells government securities, the money supply goes down and interest rates go up. So that's what happens in those cases. So Janine asked a question: for UK being a member of the European Union before Brexit happens, did EU have control of their money supply or not really? That's a good question. So that question, they were part, that's a really good question. the UK was part of the European Union up until recently, but they did not use the euro. So they were part of the European Union, but they still kept the UK pound. Smart decision. So it was a very smart decision that they did this, and the UK made the right decision. And they had good economists behind them to make this decision. Mark Carney was the Bank of England governor from 2013 to I think it was about 2021, and also he was the Bank of Canada governor before 2013. So they made the right decision to have the pound stay, because this would allow the UK government to print money, to borrow from the Bank of England, printed money. And this would provide more flexibility and more opportunity for the UK government to spend more and pay off debt with cheap money from the Bank of England. So that was a good decision they made, just keeping the pound, because if they didn't keep the pound, they wouldn't have flexibility. And so yeah, good question about reserves. I'll just copy this and send this over to everyone. So good question about reserves. The reserves. So reserves. So yeah, reserves are, so I sent that over. So reserves are money that are, so with reserves are the money that is collected and stored by the Bank of Canada. So it is cash sent from the banks to the Bank of Canada to hold and not lend out. So the reason why they have this, why they have reserves, is to have money to provide for withdrawals from the bank, people taking out money, and also to decrease the money supply when needed. So like if reserve requirements go up, more money is sent to the Bank of Canada and less money is being lent out as loans. So like so basically so if less money is being loaned out, the money supply goes down. If more money is being loaned out, the money supply goes up. So that's what happens here. And that's why like higher reserve requirements means lower money supply, then lower reserve requirements equals higher money supply. So they can manipulate the reserve requirement to increase the interest rates. Yes, yes, exactly. So they can so what they can do to increase a good point there. So to increase interest rates, they would increase the reserve requirement. Yep. And then to decrease interest rates, they will decrease the reserve requirement. Yeah. So yeah, good point on that. Like changing the reserve requirement, the interest rate will change. Yeah, good job. Good questions, everyone, on that. So I'll send this over for everyone. So this will be in the chat for everyone. There it is. Some good questions. So the contractionary policy, that's raising interest rates. And that's to sell government securities, bonds, treasury bills, etc., and increase the reserve requirement to reduce money supply. So they can, so for contractionary policy, they can do any of these three things, and it will be contractionary. So they can do any of these three things or all of these three things. So any of these three things will lead to contractionary policy. So that's what, so the government is doing that right now. So 2022, so 2022, the government did this to reduce inflation. So they did this in 2022 to reduce inflation. Yeah. So that's what they did. So if they do contractionary monetary policy, this reduces interest rates. It's selling government securities, bonds, treasury bills, etc., and it's increasing reserve requirements to reduce money supply. And it leads to slower economic growth, higher unemployment, reduced consumer spending and investment, and ultimately lower inflation. They want lower inflation, and that's why the Canadian government and the US government did this last year. And right now, they've been doing it that last year and this year. So they're trying to bring down inflation. Then expansionary policy, that's lower interest rates, they print money, they buy government securities, and they reduce the reserve requirement to increase the money supply. So that's what they do for expansionary monetary policy. So they do all those types of things there. And then expansionary monetary policy through lower interest rates, printing money, buying government securities, and reducing the reserve requirement to increase the money supply. This leads to more consumer spending and investment, lower unemployment as business expands, and increased inflation. So the Bank of Canada changes interest rates. So it's similar to the Fed. And then other factors also determine the commercial bank interest rates. Buy and sell government securities works the same way as the Fed. So the governments can increase the money supply by printing more money, not a popular option. So monetary policy and global business. So if the interest rate goes up, foreign investment goes up, value of currency goes up, exports decrease because they're more expensive. Imports increase because they're less expensive. So in this case, yeah, this is a good flow chart here. So higher interest rates lead to higher foreign investment, lead to higher value of the currency lead to more imports, lead to less exports. Yeah, so that's what happens here for if you increase the interest rate. So fiscal policy is government programs and spending and taxation. Government spending is in the federal budget each year. It focuses on unemployment benefits, social assistance programs, so low-income supplements, subsidies and grants for certain industries, such types of businesses, public infrastructure, and public services, so roads and highways, public parks, etc. Then taxation comes from income tax, capital gains tax, sales tax, and property tax. So fiscal policy increase or decrease. So contractionary fiscal policy is when you decrease spending and decrease taxes for governments. Increase taxes, yeah. And then it leads to less consumer income for spending, businesses that grow at a slower rate, and then higher unemployment and lower inflation. And expansionary policy, that's when you increase government spending, decrease taxes, and this leads to increased consumer spending, higher business growth, lower unemployment, and increased inflation. So the federal budget, so revenue versus spending, that's a big problem that they have, the revenue versus spending. They want the revenue is from taxes, and the spending is on government services, programs and services. So government budget deficit is when spending is greater than revenue for a year, for 1 year. So they can reduce spending or increase taxes to balance. If balance is impossible, then government must borrow money. So they can borrow money from they can borrow money from their central bank. The central bank prints the money, and then the government borrows the printed money. So they can do that so they can do that to pay off the deficit here. And also the government can also borrow from businesses and the public through issuing government bonds or treasury bills. So like if the government issues bonds or treasury bills, whoever buys them will be lending to the government, and the government will be borrowing from them. So that's what happens when that's how a bond works, or a treasury bill. That's how it works. And then, but however, most borrowing takes place through the government borrowing from the central bank. In Canada, like specifically in the US. So the US borrows most of their money from the central bank, the Fed. So that's usually what happens there. So the US borrows mostly printed money. So the US borrows mostly printed money from their central bank. So what are the cons of printing money into the economy? So that's a good question. So the cons are hyperinflation. So that can happen, hyperinflation can happen. So like I'll take a screenshot of this and then so hyperinflation can happen where so I pasted that here. So I'm just going to delete this. I sent it over for everyone. So the hyperinflation can happen, and that is where inflation is so high that like trillions, that like inflation is so high that no one can afford anything anymore. So I'll bring up a case study for Venezuela. What happens with